Hello, my name's John Gullo, Chief Investment Officer of Sanderson Wealth Management, and I'll be walking you through this quarter's 15-minute financial update. Please remember, you can pause, rewind, or stop the presentation at any point in time. The 2010s proved to be a decade of continuous economic growth. The U.S. experienced growth in each of the past 10 calendar years, a phenomenon not seen since the 1960s. While the pace was not record-setting, annual economic growth averaged 2.3% during the decade. In addition, the current expansion, which began in mid-2009, is currently in its 127th month. As such, this is now the longest U.S. expansion since record-keeping began in the mid-1800s. To put it in perspective, since World War II, the average expansion has lasted roughly 58 months. Labor markets improved dramatically over the past 10 years as businesses recovered from the Great Recession. The official unemployment rate fell from 9.9% to 3.5%. Even the more encompassing unemployment measurement, which includes discouraged workers as well as involuntary part-time workers, fell over 10%. At the same time, the number of unfilled positions, or job openings, has risen from less than 2.5 million to over 7 million. As you may expect, with the unemployment rate falling and job openings rising, over time this has caused wages to rise as employers compete to attract workers. In turn, higher wages and more people working has boosted median household income from below $50,000 per year to over $60,000. While not a gargantuan increase, the math boils it down to an average annualized increase of just under 3%, a level which has outpaced inflation. When compared to other parts of the world, the U.S. economy grew roughly 25% over the past decade, outpacing foreign developed economies at 15%, but falling short of the astonishing 62% growth achieved in emerging economies. As such, when we break down global output by economic status, the picture is quite different over the course of a decade. In 2009, the U.S. economy was responsible for 26% of the goods and services produced. Foreign developed economies produce 44%, and emerging economies 30%. Today, little has changed for the U.S., which produces slightly more than 27%. But things look quite different outside the U.S. Foreign developed countries, which include Europe and Japan, grew at a slower pace and now only produce 34% of total goods and services. Where stronger growth in emerging economies, most notably in Asia and the Far East, grew dramatically and increased their share of the pie to 40%. Despite relatively modest economic growth, U.S. stock prices soared over the past 10 years, gaining 253% when measured by the S&P 500 index. Foreign stocks, however, did not fare quite as well, increasing 99% for foreign developed country stocks and 83% for emerging markets. These outsized returns of U.S. stocks led to a dramatic increase in their market capitalization, which grew from 42% in 2009 to over 55% today. As a reminder, market capitalization refers to the total dollar value of a company's outstanding shares of stock and is commonly referred to as market cap. Today, U.S. stocks represent roughly 56% of the investment universe, with foreign developed and emerging markets representing 32% and 12% respectively. Interestingly, the total value of U.S. stocks represents 56% of the world's investable universe, when as a country, we only produce 27% of the world's goods and services. One contributor to U.S. stock market performance was the availability of cheap financing. At the start of the decade, interest rates were near zero and remained at that level for nearly 6 years. The Federal Reserve increased interest rates for the first time in December of 2015 and did so several additional times over the course of the next 3 years. Following some turbulence in the financial markets in late 2018, the Federal Reserve reversed course and began to lower interest rates once again to calm financial markets and prolong the economic expansion. In the end, short-term interest rates averaged an extremely low level of 0.6% over the decade. Now, to put this in perspective, short-term interest rates averaged 5.9% over the prior 5 decades, from 1960 through 2009. Clearly, a significant difference in borrowing costs. With cheap money readily available, many hoped corporations would increase spending on research and development, modernizing facilities, or expanding operations. While some companies did spend money in that fashion, many simply increased borrowings to buy back their own stock. In fact, large U.S. corporations spent over $5 trillion buying back shares of their own stock. Some companies also borrowed money in order to pay special dividends to existing shareholders, but dividend payments did not increase nearly as much as buybacks. The funny thing with company buybacks, though, is that they do nothing for the long-term health of a company. They don't make operations more efficient, develop new products, nor improve a company's existing lineup of products and services. Buybacks are, however, very helpful in boosting stock prices, which in turn helps boost managerial compensation and stock option values. As you can imagine, all this borrowing adds up. Over the past 10 years, business debt increased from $10 trillion to $16. In contrast, household debt only increased modestly, from $14 trillion to $16. Now, many of you may be wondering what your neighbors have been borrowing money for. For the most part, it's mortgages, which account for 66% of total household debt. The second biggest slice of the pie, at 10%, is student debt. Unfortunately, student debt has grown from $232 billion at the beginning of the decade to $1.3 trillion at the end of the decade. With the amount of student debt more than quadrupling over 10 years, it is now not only a financial problem, but a political problem we are sure to hear more about in the coming months. In addition to lowering short-term interest rates, central banks began to experiment at the end of the Great Recession with another tool, a phenomenon known as quantitative easing, or QE for short. The process essentially involves central banks purchasing government bonds or other securities as a means of pushing cash into the financial system. The goal was to reduce interest rates, increase lending, and spur economic growth. Between 2008 and 2019, combined, the U.S. Federal Reserve, European Central Bank, and Bank of Japan grew their balance sheets from less than $3.5 trillion to in excess of $14.6 trillion. While there have been defined asset purchase programs, such as the U.S. QE1, QE2, QE3, the European QE program, Japan's never-ending QE program, and the rebirth of asset purchase programs in the U.S. and Europe in late 2019, the end result has been a fairly steady growth of central bank balance sheets over time as the combined entities seem to always be purchasing assets. While the jury is still out on how beneficial this has been for the real economy, it is difficult to deny that central bank actions certainly helped to contribute to the rise of U.S. stock prices over the past 10 years. Stock prices in the U.S. were also helped along by falling tax rates. In the beginning of the decade, the U.S. was at a disadvantage to many of its trading partners with a top marginal corporate tax rate of 39.2% versus the average for industrialized countries of 25.3%. Fortunately, the Tax Cuts and Jobs Act of 2017 helped remedy that situation. At the end of the decade, the top marginal tax rate for U.S. corporations fell to 25.8%. This can be clearly displayed in the actual tax rates of S&P 500 companies, which fell from 26.4% to 17.7%. Unfortunately, neither lower taxes, lower interest rates, nor added stimulus from central banks had a significant effect on corporate revenues. In the end, the long-term viability of a company depends on its ability to increase sales of products and services. Unfortunately, large U.S. companies were only able to grow annual sales by 4.4% on average during the decade. When adjusted for inflation, this means that companies were only able to grow unit sales by about 2.5%. This brings us to valuations. We can measure valuations in many ways, but each of them tells the same story. Whether it's price to book value, price to cash flow, price to trailing 12 months of earnings, or a 10-year price to earnings ratio, there's no sugarcoating it. U.S. stocks are expensive. In the case of price to earnings ratios, where we can track them over long periods of time, the U.S. is expensive compared to its long-term historic average. The U.S. is also expensive compared to other areas of the world. While there is no imminent risk of a market correction, and valuation ratios have been at high levels at other points in history, investors should take time to pause and review their portfolios to make sure they are not overly concentrated in U.S. stocks, or taking on more risk than is wise at their stage of life. As we alluded to a moment ago, we believe now is a good time to reflect upon what is in your portfolio and consider rebalancing. Right now, some of you are thinking, why should I sell an asset or asset class when it's been performing so well? The reason is because asset class performance tends to rotate. For example, in the late 90s, U.S. large company stocks were the best performing asset class, only to become the worst over the next 10 years. In contrast, emerging market stocks were the worst performing asset class in the late 90s, only to outpace U.S. stocks for the next 10 years. In fact, emerging market stocks outpaced everything from 2005 to 2009. There are numerous times in history when the prior winners become the future losers, and the prior losers become the future winners. We do not know what the next 10 years will bring, but we suspect U.S. large company stocks will not lead the pack over the next decade. Lastly, the federal government closed the decade with a significant piece of legislation, the Setting Every Community Up for Retirement Enhancement Act of 2019, or SECURE Act for short. Now, we'll talk more about this in the months to come, but here are a few highlights. First, the new law will make it easier for companies to set up 401ks. It will also encourage plan sponsors to include annuities as an investment option for retirement plans. It will push back the age for requirement distributions from the current age of 70.5 to 72, but only for those who did not reach 70.5 by 12/31 of 2019. It will allow the use of 529 plan assets to help pay off student debt. The law removes the age limit at which an individual can contribute to a traditional IRA, but also removes provisions which allow beneficiaries to stretch inherited IRA distributions over their lifetime. Instead, many will need to withdraw assets from an inherited IRA within 10 years following the death of the original account holder. There are a few exceptions, such as assets left to a surviving spouse, a minor child, a disabled or chronically ill individual, and beneficiaries who are less than 10 years younger than the decedent. Thank you for watching our presentation today, and if you have any questions or comments, please do not hesitate to give us a call. Have a great day.